Okay, these are my notes from the 1997 Berkshire Hathaway meeting. This is just the most important parts that I thought would be the most practical or useful. Warren said stock prices can get ahead of businesses, so it's hard to find them when they're cheap. Someone asked a question, why Warren Buffett aims for 15% return, a 15% return, but delivers 24%. Why the huge 9% gap? His answer, the market was good, so they got a tailwind. 15% every year is very good. He wouldn't want to sign his name to anything better. On volatility, many people think volatility is a bad thing. He says volatility is a good thing. It provides more opportunities to buy. Wild swings means more things get mispriced. The market should serve, not instruct. Warren can't understand why a stock is riskier after it has fallen. Warren tries to explain what it means to understand a business. To quote-unquote understand a business means to know where a business will be in 10 years. The amateur, as long as he recognizes he's an amateur, will do better than the professional in investing. Buffett says he can determine in about 5 minutes whether he's interested in a business or not simply by using some simple filters. He bought the company Flight Safety without ever visiting it, because the fundamentals of the business are the most important thing. Charlie Munger says people underrate the importance of a few simple big ideas, and a CEO needs to love the business. Having the right person or CEO in place is enormously important. Charlie Munger said, one filter that's useful is opportunity cost. If you know something better, you can concentrate in the better one. This concentration approach is not copied. More people should do it. Buffett says, would you rather own company B or more of Coke, for example? Is this better than buying more of what you already own? That's what you should be asking. Don't dabble around the edges when you could wait and go big on a no-brainer investment, said Warren. Warren said, when you buy a stock, ask yourself if you'd be happy buying it if the market closed for 5 years. If your answer is yes, then buy it. The key thing in economics or anything in life, when someone makes an assertion, you always want to say, and then what? What else does that mean? Ben Graham's 3 basic ideas that underlie successful investing are: 1. Look at stocks as businesses, not pieces of paper or just numbers that fluctuate on a screen. You have to look at them as businesses. 2. Have the proper attitude toward the market, as sometimes irrational. So you have to look at the market as something to serve you, not instruct you. Sometimes it's rational, sometimes it's very irrational. 3. Operate with a margin of safety. Then he mentioned something about focusing on wonderful businesses, not just cheap businesses. Phil Fisher, the writer and professor, and Charlie Munger both espouse looking at wonderful businesses, which moved Warren Buffett away from his original way of thinking, which was only to find cheap businesses. What filters to use when picking stocks? Opportunity cost is the biggest, said Charlie Munger. Warren said, 1, first, can we understand it? 2nd, does it have a sustainable edge? Charlie says another filter is finding a quality person, a CEO or owner. Avoid bad people and you'll avoid a lot of misery, he said. Okay, notes from the 1998 Berkshire Hathaway meeting. You get paid just as well for easy dives as you do for difficult backflips. Look for low bars, easy jumps. Efficient market theory is flawed, so it helps us value investors to get bargains, to paraphrase. On Japanese companies and low prices. It's extremely difficult to get rich on companies with a low return on equity. Many years ago, we gave up the cigar butt approach. A 5% ROE, or return on equity, is not good, but a 20% ROE is. Time is the enemy of the poor business, and it's the friend of the great business. A 20 to 25% ROE is great, and time is your friend. Time is your friend if you have a very high ROE. Charlie Munger said, "It's not that much fun to buy a business where you really hope this sucker liquidates before it goes broke." That's in reference to buying companies that are below book value and then just hoping you can get more than the book value for it. The only reason to sell a business is when you find something immensely better, said Charlie Munger. And you buy one when you find something you like selling at a price you like. We should have done more of that in the past, said Warren. We look for the fat pitch, when you know all the variables and they look good. Warren said if he gave a test at university and he asked a question, how much is this internet company worth? And if the students gave an answer, he'd flunk them. Warren doesn't know where tech companies will be in 10 years, so he won't buy. There'll be a lot of money made in many areas, but he won't buy, so the more power to them. We never wanted to use leverage to buy back shares. A company doesn't get credit for gross cash flow, but net cash. The best business is one that gives you more money every year without putting up anything. The second best business is one that also gives you more money and requires more money, but the rate is very good. The worst business of all is the one that grows a lot, but you're forced to grow to stay in the game at all, and where you're reinvesting capital at a very low rate of return. A low PB, or price-to-book ratio, with low earnings is not attractive. Low PB is probably indicative of a poor business. Low PB and only 5% return is not good. This was in reference to Japanese companies at the time that had a low PB. It's a good business if you see that the decisions are easy, not difficult. Charlie said they won't sell everything to go to cash if a crash or a depression comes. Question: why is he not investing, and why is he letting cash pile up? He'll wait as long as needed to buy something attractive, not a 5 or 10% drop, but bigger. No time frame is needed, even if money piles up. You don't get paid for activity, only for being right, said Buffett. An occasional dull stretch is no great tragedy, said Charlie. The businesses aren't going to perform better in the future just because you got antsy and decided to buy something, said Warren. Volatility is great if the business is still good. How would I feel if I bought this and held it forever? This is the question to ask before you buy.